Everyone understands, I think, that we've got a big problem after the last 15 years of having very, very large balance sheets in the developed Western economies. And the question is what to do about them. Essentially, the choices are either to keep inflation low and try to sweat off these imbalances over time, or if there's an upwards adjustment in the price level, that can do a lot of the work for you. And it's worth noticing that this is happening sort of under the radar. I'm not sure people have realized quite how much real financial balances have come down over the last couple of years.
Welcome back to Breakout, brought to you by PGIM. I'm Peter Thal Larsen, the global editor of Reuters Breakingviews, and I'm joined once again by Felix Martin. Felix, welcome back.
Thank you, Peter. Very good to be here.
So Felix, you've written a thought-provoking column for Breakingviews this week about the benefits, the practical benefits of inflation, and your point seems to be that upward changes in the price level can be quite useful when economies are absorbing shocks. Just can you explain a bit more what your thinking is there?
Yes, sure. You're absolutely right. I'm trying to be provocative because I think it's a very important argument. It's an argument, by the way, which was around all the way up until the late 90s when inflation targeting became really the orthodoxy in central banking. But before that, this was there was a big to and fro about this question of what the benefits and drawbacks of higher inflation temporarily are. And there's really two big problems that we face in the developed economies at the moment. One is the problem of huge accumulated financial imbalances, so very high levels of debt and so on. And the other one is a fact which has been talked a lot about recently, which is a lot of real shocks hitting economies. So we've had the pandemic and supply chain shocks, and we've had recently food price shocks and so on. And these are things which make the economy poorer in real terms. And the big question is, how to affect the adjustment to these things. And the argument that I make in the column is that inflation, a bout of temporary inflation, an increase in the price level, can actually be pretty helpful.
Okay, interesting. I mean, so let's just taking a step back a minute, just thinking about the sort of the traditional risks of inflation. I mean, people talk about, uncertainty in prices. Sort of makes it difficult for people to invest or kind of figure out what to do with their money. They spend a lot of time worrying about the price level, changing prices, adapting to things. Are those not sort of real concerns?
No, you're exactly right. I mean, first of all, one has to distinguish, of course, between just saying, look, the cost of living crisis, prices going up, surely this must be bad. That's true, of course, but you're only looking at one side of the ledger. The other side of the ledger is, what we're seeing at the moment, record corporate profits and so on. So what we're really interested in, and what monetary policy makers are interested in, is the overall aggregate social costs of inflation. And you've just mentioned a few of the ones which, you'll find if you go and look in the economics textbooks, they've got a few of these things. How does inflation make economies more inefficient and poorer? But they're not very convincing, never really have been. Menu costs, that's, you've got to change the prices on labels on things, but we live in a digital age. And shoe leather costs, that's one they used to come up with. People try and economize on cash, and so in the olden days they used to have to go and shift money from their deposit bank to their savings bank. I mean, in the era of these bank runs at the speed of Twitter that we've just seen, that's not very realistic either. The point about uncertainty is an interesting one. It is obviously quite important, but it's really more to do with volatility of inflation than it is with any particular target or level of inflation. So all of these things, they're not really very convincing, never really have been. James Tobin, the great American economist, in a famous presidential address to the AEA back in 1971, when he was talking about this, he ran through these things, and his ultimate verdict was, what a letdown.
So then let's talk about the current situation. I mean, obviously we've had inflation. Many Western countries risen and stayed high beyond what many central banks expected, now doing their best to whack it down. I mean, obviously central banks worry about wage price spirals and so forth. But you also make the point that it's had some benefits just in terms of what happens to the stock of debt.
Yeah, I think that's the simplest one to understand. Everyone understands, I think, that we've got a big problem after the last 15 years of having very, very large balance sheets in the developed Western economies. And the question is what to do about them. And, essentially, the choices are either to keep inflation low and try to sweat off these imbalances over time, or if there's an upwards adjustment in the price level, that can do a lot of the work for you. And it's worth noting that this is happening sort of under the radar. I'm not sure people have realized quite how much real financial balances have come down over the last couple of years. This is what happens when you have 20%, more than 21% nominal growth, for example, in US GDP over the last 2 years. When you have nominal growth at that sort of speed, that's the denominator for things like debt to GDP, it makes a big difference, and it eats a long way into these imbalances.
Yeah, so that's I guess that's good news if you're if you're a borrower. It's probably also good news if you've got a job or whatever, because the central banks aren't if allowing a bit of inflation means you don't have to have as much unemployment and so forth. But probably not so great if you're an investor, and particularly an investor in government or corporate bonds.
Yeah, of course, you're absolutely right. The point is that the main effects of inflation are redistributive, and so they're going to be winners and they're going to be losers. Now, when we look from the perspective of the economy, which should be pretty important to all investors, we're asking the question: what's best for the economy as a whole? What makes it most dynamic over time? And the argument I'm making is that kind of adjustment we're talking about, that's really it has to happen, and it's pretty good over the long term for investors. You're absolutely right, of course. You don't want to be in nominal bonds, for example. You don't want to be an investor in nominal bonds when this is going on. We all know that. Inflation in this case is affecting a redistribution from creditors to debtors. The other thing that I think is less obvious to a lot of people is the potential for inflation to help in the labor market adjustment. Again, if we've had, for example, a big energy price shock like we have, but a big food price shock, what it means is that some industries are going to do worse than others. Some lose competitiveness. Energy intensive industries and import intensive industries lose competitiveness. And again, the question is, how does this adjustment happen? And the argument is it's much easier when you've got a rising price level for certain industries to affect real wage cuts, but not to shed labor. So instead of having a lot of unemployment, people being chucked out onto the streets, you can affect real wage cuts in some industries and rebalance the economy that way.